Hey everyone, welcome back to our channel. Today, we're going to explore an inspiring journey of financial growth and independence. Imagine having your money work for you instead of you working for your money. That's exactly what Martins did with his $15,000 savings. In this video, we'll uncover how he discovered the power of dividends and transformed his savings into a reliable source of income. So, grab a snack, get comfortable, and let's dive in. The challenge of keeping cash. Let's start by talking about cash. While having cash on hand is great for emergencies, it can lose value quickly in an inflationary environment. Martins realized that simply letting his money sit in a bank account wasn't the best strategy. Instead, he wanted to make his money work for him and grow over time. The power of dividends. That's when he learned about dividends. Dividends are payments made by companies to their shareholders, and they can be a fantastic way to earn passive income. Martins was intrigued by the idea of investing in dividend stocks that could provide returns higher than inflation. He wanted to ensure that his money not only stayed safe, but also grew. Investment strategies unveiled. Martins discovered 3 powerful investment strategies, each one better than the last. Let's break them down and see how much he could earn over different time frames. 1 year, 10 years, 20 years, and even 30 years. Strategy 1. Covered call ETFs. The first strategy on Martins' list was covered call ETFs. These are unique investment funds that not only invest in stocks, but also use options to generate additional income. How it works. When you invest in a covered call ETF, the fund buys stocks and sells call options on those stocks. This means they can earn money from both the stock's appreciation and the option premiums. The best part? Martins doesn't have to do any of the heavy lifting. The fund manages everything for him. The benefits. Covered call ETFs can provide a more stable and reliable stream of income. However, Martins learned that there are risks involved, like options expiring worthless or stock prices declining. Top picks. Some popular covered call ETFs include QYLD, XYLD, and RYLD. With an average dividend yield of 12.53%, if Martins invests his $15,000 today, he could earn about $1,880 in the first year. The snowball effect. The real magic happens when Martins reinvests his dividends. Over 10 years, his investment could grow to $51,513, yielding $6,764 annually, or about $564 monthly. In 20 years, it could balloon to $176,903, providing $23,229 a year, or $1,936 monthly. And in 30 years, a whopping $607,515, with an annual dividend of $79,774, translating to around $6,648 monthly. Strategy 2. Real Estate Investment Trusts, REITs. Next up, Martins explored real estate investment trusts, commonly known as REITs. Think of REITs as a group of investors pooling their money together to buy properties. The rental income generated from these properties is then shared among the investors. Why REITs? Historically, REITs have shown solid performance, averaging a 10% annual return over the past 2 decades. They often pay dividends monthly, making them an attractive option for those seeking steady income. Martins was excited about the potential of REITs to provide him with regular cash flow. The risks. However, Martins learned that REITs can be volatile, depending on the economy and rental demand. If the economy is struggling, the income from properties can decrease, affecting the dividends paid to investors. Top picks. Some of the best REITs that Martins considered included Blackstone Mortgage with a 10.8% yield, Orchid Island Capital at 16.6%, and Esco Mortgage Capital at 18.8%. If Martins invests $15,000 in these REITs, he could earn about $2,310 in the first year. Reinvesting for growth. If he chooses to reinvest his dividends, in 10 years, his investment could grow to $67,975, yielding $11,088 annually, or about $924 monthly. In 20 years, it could reach $308,043, providing $50,249 a year, or $4,187 monthly. And in 30 years, a staggering $1,395,955, with an annual dividend of $227,714, or about $18,976 monthly. Strategy 3. Dividend Aristocrats. Finally, Martins discovered dividend aristocrats. These are companies in the S&P 500 that have consistently increased their dividends for at least 25 years. They are like the champions of stability and reliability in the stock market. Why invest? Investing in dividend aristocrats can be one of the safest choices. These companies are known for their strong financial management and ability to grow while sharing profits with shareholders. They often sell products and services that people need, even during tough economic times. Top picks. Some standout dividend aristocrats that Martins considered included ABV, which has a 10-year dividend growth rate of 17.16%, Visa, with 19.02%, and Broadcom boasting an impressive 37.71%. If Martins decides to invest in these companies, he can expect a solid return. The potential returns. If Martins invests $15,000 in dividend aristocrats, he could earn an annual dividend of $3,694 in the first year. But the real excitement comes from reinvesting those dividends. In 10 years, his initial investment could grow to $135,618, yielding $26,801 annually, or about $2,233 monthly. In 20 years, it could skyrocket to $1,226,149, providing an astonishing $242,317 a year, or $20,193 monthly. And in 30 years, a jaw-dropping $11,085,853, with an annual dividend of $2,730,445, or around $227,537 monthly, creating a balanced portfolio. Now that Martins had explored these three powerful strategies, he realized the importance of diversification. He didn't want to put all his eggs in one basket. By creating a balanced portfolio that included covered call ETFs, REITs, and dividend aristocrats, he could manage risks while still enjoying the benefits of high returns. Average returns. By combining these three strategies, Martins could achieve an average return of 17.52%. This diversified approach would allow him to earn higher returns while keeping his investments safer. It was a win-win situation. Projected earnings. If Martins invests $15,000 in this balanced portfolio today, he could earn approximately $2,628 in yearly dividends in the first year. But the real magic happens over time. In 10 years, his investment could grow to $83,326, yielding $13,130 annually, or about $1,094 monthly. In 20 years, it could reach $462,886, providing $72,940 a year, or $6,078 monthly. And in 30 years, a staggering $2,571,381,000, with an annual dividend of $405,187, or $33,818 monthly. The importance of reinvesting dividends. One of the key takeaways from Martins' journey is the power of reinvesting dividends. By reinvesting, he could take advantage of the compounding effect, which allows his investments to grow exponentially over time. The snowball effect. Just like a snowball rolling down a hill, as Martins reinvests his dividends, he buys more shares, which leads to even higher future payouts. This process keeps repeating and growing over time, significantly increasing his wealth. The longer he stays invested, the more powerful this effect becomes. Engaging with the community. As Martins continued his investment journey, he realized the importance of community and support. He joined online forums and local investment groups where he could share ideas and learn from others. This not only kept him motivated, but also provided him with valuable insights into the market. Learning from others. By engaging with fellow investors, Martins discovered new strategies and tips that he hadn't considered before. He learned about the importance of staying informed about market trends and economic indicators that could affect his investments. Sharing knowledge. Martins also began sharing his own experiences and strategies with others. This not only helped him solidify his understanding, but also allowed him to give back to the community that had supported him, staying disciplined and patient. One of the most crucial lessons Martins learned was the importance of discipline and patience in investing. Avoiding emotional decisions. It's easy to get caught up in the excitement of the market or panic during downturns. Martins made a commitment to stick to his investment plan and not make impulsive decisions based on short-term market fluctuations. Long-term perspective. He understood that investing is a marathon, not a sprint. By maintaining a long-term perspective, he could ride out the ups and downs of the market and benefit from the compounding growth of his investments. The role of education. Martins also prioritized his financial education. He understood that knowledge is power, especially when it comes to investing. Continuous learning. He read books, attended webinars, and followed reputable financial news sources to stay informed. By continuously educating himself, he became better equipped to make informed investment decisions. This commitment to learning helped him refine his strategies and adapt to changing market conditions. Understanding risks. Through his studies, Martins gained a deeper understanding of the risks associated with different investment strategies. This knowledge allowed him to make more calculated decisions and manage his portfolio effectively. He learned to assess the risk-reward ratio of each investment, ensuring that he was comfortable with the level of risk he was taking on. Setting financial goals. As Martins progressed in his investment journey, he set clear financial goals for himself. Short-term and long-term goals. He established both short-term and long-term goals, which helped him stay focused and motivated. Whether it was saving for a vacation or planning for retirement, having specific targets made his investment journey more meaningful. Tracking progress. Martins regularly reviewed his portfolio and tracked his progress toward his goals. This not only kept him accountable, but also allowed him to make adjustments as needed. By monitoring his investments, he could identify which strategies were working and which needed improvement. The impact of technology. Martins embraced technology to enhance his investing experience. Investment apps. He utilized investment apps that provided real-time data, analytics, and tools to help him make informed decisions. These apps made it easier for him to monitor his investments and execute trades quickly. With just a few taps on his phone, he could access valuable information and manage his portfolio on the go. Robo-advisors. Martins also explored robo-advisors, which offered automated investment management based on his risk tolerance and financial goals. This option provided him with a hands-off approach while still benefiting from professional guidance. It was a great way for him to diversify his investments without having to manage everything himself. Conclusion: your path to financial freedom. In summary, Martins's journey illustrates that anyone can achieve financial freedom with the right mindset, strategies, and support. By exploring covered call ETFs, REITs, and dividend aristocrats, he found ways to make his money work for him. So, if you're looking to grow your wealth and achieve financial independence, consider these strategies. Remember, it's never too late to start investing and making your money work for you. If you found this video inspiring, please like, subscribe. Thank you for watching, and we'll see you in the next video.